Good afternoon, everybody. This is Steve Tuttle from Krasny Financial. I'm a portfolio manager here and partner at the firm. I wanted to thank you all for participating in our call today. Joining me today is Eugene Yashin, also a portfolio manager and partner, and he's our resident expert on the equity markets and strategist. So we're looking forward to a lively call. I think we have some good conversation pieces to discuss. And we'll jump right in it, and hopefully we'll get everyone off the call fairly quickly and fairly efficiently. So disclosure screen is on the page right now, so if you can quickly just glance that over, and then we'll get started with the agenda. So today we're going to start with, and our focus is going to be on stocks, the U.S. equity market. That's going to be our main point of the conversation. So we're going to go through at a high level, an overview of the U.S. equity markets and what we're seeing currently and in the recent past. We'll quickly update on some of the interesting components that make up the broad equity markets, focusing on size, large versus small, and style, value versus growth. And then we'll talk a little bit about our multi-factor model and some more details on how different sectors are performing in the stock market today. And then some insights on the factors and what we're seeing presently. And then finally, we'll conclude with some specifics on our equity portfolio models that many of our clients have in their portfolios, and we'll highlight some of the areas that have been working well, and also highlight some of the areas that aren't working as well. And we just completed a rebalancing a few weeks back, so we'll also highlight some of the changes that we made in our models. And we'll end with a quick Q&A session. I thank you. Some of you have sent in some questions, some very good questions, and so we'll try to cover a few of those at the end of the call. So let's just start with an overview of the equity markets, and we'll start with some economic data that we like to reference. We really think it's important to base decisions on evidence, and that starts with data, and there's several indicators that can help us help guide some of the decisions that we make in the portfolio. So we highlight a few of them here. So in terms of volatility, volatility is very low presently. Actually, for going on 2 months now, there hasn't been a 1% move in the S&P 500 in any day, up or down, and so volatility is very low. In terms of the bond markets and the yield markets, which do have some influence on what happens on the stock side, yields are very low. The 10-year Treasury is right around 1.5%, a little bit higher than that today. In terms of the yield spread, so the difference between longer bonds and shorter bonds, and also the credit spread, the difference in yield between higher credit quality bonds and lower credit quality bonds, both indicators are within a fair value or average range. The inflation from the economy, those numbers are still fairly low. And in terms of overall economic growth in the U.S., the GDP is not growing fast, but it is growing. So if we look at all these in totality, we think overall, one, the trends that we're seeing kicking off the second half of 2016 seem to be a little bit stronger than they were in the first half of 2016. And overall, we think equities should perform well in that type of backdrop. That doesn't mean that we don't expect some volatility to crop up, and there's certainly risks that we're watching very closely, and some of those include, politics and the U.S. elections coming up, central bank policies. There's a lot going on, not only in the U.S. with the Fed, but also globally. Oil prices, they seem to have stabilized recently, but that also is an area where you could get a spike in oil prices or a downdraft in oil prices, which do resonate through the economy. And then finally, because we are in a global marketplace, what happens overseas influences what happens here in the U.S. So we do watch closely China, Europe, and Japan in particular, where there seems to be some deflationary pressure that's still resonating. In terms of the recent past, if you look at what occurred in August, S&P overall was basically flat. Mid caps and small caps were slightly positive. Small caps were the best performing asset class of those three, and small and mid have outperformed large this year so far, and that's been a change from the recent past, the last several years, and we'll talk a little bit more about that. What's interesting though is so the S&P 500 was basically flat, but if you look at the underlying holdings in the sectors, there seems to be some change in leadership that's occurring. Financials and technology had a strong month in August, and telecom and utilities, which are more defensive in nature, were actually down for the month. So that's a change from what took place in the first half of 2016. We think that's actually an encouraging sign, and could have longer to run, but it's something that I think is notable and something that we watch pretty closely. And then again, volatility remains very low, and there have been no 1% moves since going back to the beginning of July. So I did highlight the flat S&P market in terms of the overall level, but one thing that if you're a client of ours, you're very well aware of, we do believe that there are some cyclical movements in the markets that are worth tracking, and one of those factors that we look at is the value factor. So we like to compare how value stocks and oriented sectors are performing relative to growth stocks. And on the screen right now, it just shows how the value factor is positive year to date and the trailing 12 months, and that's something we've been discussing for quite some time. If you look at the size factor, so if we compare larger stocks to smaller stocks, we also see some change from the recent past. So the size factor, small and mid caps, have started to outperform large caps in the U.S. market. And again, it's something that we track and we have discussed, and we do view it as a positive sign overall. So with that, I went over some high-level notes. With that, I'll introduce Eugene. He's going to cover some more high-level factors and then get into some more of the details on our model portfolios. Eugene, it's all you.
Yes, I'm here. Thank you so much, Steve. I would like to start with the graphs of the yield curve and credit spreads, and Steve already touched upon those. One thing I do want to highlight that in 2015 we saw actually both of these macro indicators in the zone of they actually didn't indicate any storms on the horizon, so to speak. They were in a very positive zone, and they forecasted the economy to grow at a healthy pace. So nothing really told us in the time frame that we will be experiencing a fairly volatile and fairly risk-off year since the middle of 2015. That limitation brought us to to some of new thinking and adding to our macro model, which allows us to look at the top down at the economy, at the consumers, at the sentiment in the market, at the equity and fixed income areas in the marketplace, And we actually worked the whole year to create a more comprehensive macro view model, which I'm going to speak to recently. And this is kind of this diagram kind of shows our overall framework where we have top-down view, we have bottom-up view where we look at 3,500 companies, 1,600 ETFs, 11 sectors, 100 industries, and 100 individual factors which describe each of those 3,500 companies. And when we kind of combine the top-down view with the bottom-up view, we get a much more comprehensive picture which allows us to manage our allocation models, our individual equity portfolios, and make those tactical tilts and adjustments. So our much more comprehensive multi-sector macro model, the current read we get from it favors telecom, financials, consumer discretionaries, and industrials. We're kind of neutral on technology, materials, and healthcare, and with utilities and consumer staples experiencing tremendous growth over the last year, we find them a little bit overvalued. So we have a little negative view on them. And energy is at this point is a very uncertain area influenced by both the market forces and the speculation forces around the supply side. So this is a very involved slide. I don't want to really go into nitty-gritty of the numbers. I just do want you guys to look at the color coding. And that's the forecast for each individual economic sector over the next 12 months. So as you can see, our multi-factor macro model in September 2015 actually looked favorably at consumer staples and utilities. And that's the sign where we would we would take into the consideration, and the fact that both of these sectors were looked a little more favorable than the others would give me a pause. Probably wouldn't convince me at that time that we would should have gone over cautious towards the market, but nevertheless, that's what this new model, which includes a whole bunch of factors, tells us. But as you can see, as we progress from 2015 to 2016, both consumer staples and utilities, those sectors indicative of the risk-off environment where market participants become much more cautious, they turn to be negative, while more adventurous and cyclical sectors like consumer discretionary, financials, industrials, telecom are improving through time. And that's, again, a very encouraging sign we see in the marketplace. So over the last, 12 to 12 months, the market behaved in a very extraordinary manner. The correlations have gone wild, and I'll speak to it in a second. We still saw companies producing strong free cash flow outperforming, and we did notice that consumers in the post, great recession environment became much more cautious and conservative with their spendings. So in terms of correlations, what happened is that usually, and this is the slide which kind of speaks to the details of the previous one, usually value stocks do not really correlate with growth stocks. But this time around, over this time frame, over the last 12 months, we saw value stocks positively correlating with big growers and having 80% anti-correlation with stable stocks, which we haven't seen in a very long time, which is a very unusual combination, typical for really dramatic recessionary events. As I said, the free cash flow was rewarded, but the market participants, again, underestimated the capacity and capability of companies to produce free cash flow. And American companies turned out to be much more resilient than the market expected. And again, what gives us another point of hope, so to speak, is the fact that just like companies, the American consumers actually contain and remain a very healthy free cash flow. The savings rate are healthy, and consumers are much more conservative with their spending, especially when it comes to large purchase items. Again, this is a very involved slide. I don't want you to concentrate on the numbers, but I do want to point out the progression in time. And the first column is our fundamental score, which usually gives us a very good indication of which company is going to outperform over the next 12 months and beyond that time frame. Then we have a whole bunch of value factors, couple growth factors, profitability factors, safety, and then safety factors. And what I do want to point out, in the last 4 quarters, over the last 12 months, you see that the value factors didn't really work. The growth factors were not that fascinating. The profitability factors were somewhat strong, but the most influential part, the most influential factor out of all of this was the safety factor. So, yeah, there's a huge risk aversion in the marketplace. People prefer stability right now. People were afraid of imminent recession, which didn't materialize. We believe the business cycle is going to continue. It's going to be one of the longer business cycles, so the recession is not imminent, is not yet on the horizon, so to speak. And the other thing I do want to point out here is that the safety factor snaps back out of being in favor zone and pretty quickly. So the marketplace can be really unmerciful in terms of switching out of safety. And as you can see, it starts its decline a little bit. So we hope that the market will return to a more normal state where the risk aversion is not going to dictate everything happening in the marketplace, and the valuations and the growth factors will return to consideration. So over, since the beginning of this year, there were a few things which worked in our favor, and a few things which didn't really help our portfolios. On the plus side, we did have within healthcare, good developments for Aetna when they balance their marketplaces and optimize their participation and in some of the programs they participated in. We did see improved pipelines for some of our mega biotech, and that overall this portion of the portfolio helped the performance. Technology, very strong movement in semiconductors, helped boost the tech sector in our portfolios, and that's actually a very bullish sign for the overall portfolio as well. Industrials, we did see good improvements in building and home improvement area, and Masco is one of the companies we hold in this particular sector. Basic materials, again, energy is kind of returning with coming back from its demise, and we see in basic materials which kind of are interconnected with energy, like ADP and the producers of chemicals like New Market. really participating in this development as well. On the negative side, you obviously all know about the presidential elections, and the candidates were not real candid towards the some of the drug and pharmaceutical companies because of the prices they established for some of the medicines. So we did see deteriorating fundamentals in Gilead and McKesson. Specifically, Gilead became a big victim of Hillary Clinton tweets, and the whole biotech sector really got depressed over that time period. Energy, again, we did see volatility. We did see markets going, becoming a little more positive about energy. But then the speculation, the weaker economic growth suppresses the sector as well. So there are different forces influencing the sector. We did see specifically the shrinking refiners' margins, and that's why we saw Valero really underperforming for the in this particular time frame. And there's a big uncertainty about the refiners' margins coming back soon. Industrials, again, we did see some transportation stocks hurt. JetBlue was exposed particularly to the energy market because the airline doesn't hedge its exposure to air fuel prices. We actually are trying to capitalize on Chicago Bridge because we bought the company when it already got hurt because of its exposure to energy sector. So we're very actually, we're still confident in this player. Consumer cyclicals, the market perceives auto producers to be at the eclipse of the market cycle and the business cycle. We do see some actually encouraging signs in the space with lower wage employment improving significantly in the United States. So we actually just repositioned in this area, so we didn't quit auto producers altogether. So in terms of changes to our strategical equity portfolio, from, just to reiterate what Steve was, when Steve was talking about the size and small caps and mid caps starting outperforming large caps. Usually that's a longer cycle, which takes 3 to 6 years to evolve. So we see that cycle beginning, and we are moving towards more mid and small caps. It doesn't mean that we're quitting large caps altogether. We still have a fair presence in the large cap area, but we want to tilt a little bit towards mid and small caps. In terms of style, we are moving towards some value. The interesting thing is that we find more and more good value choices among cyclical sectors, and those defensive sectors like utilities and consumer staples have pretty expensive companies right now for us to choose from. So in terms of sectors, we're closing our underweight gap in financials, not only because we expect Federal Reserve at some point to start increasing interest rates, but irrespective of that, that would be a huge trigger for financials. But irrespective of that, a lot of financials have become much leaner, much more efficient, talking about banks, talking about insurers, and we see those companies, for the most part, producing tremendous amount of free cash flow. So we're being paid for our patience, and we want to establish the presence in the financials and close this underweighting we have at the moment. So what we did in our strategical equity portfolio we sold out of Valero, Gilead, JetBlue, and Checkpoint. And the first three positions I've kind of talked to on the previous slide for the reasons why we did sell those three. And the Checkpoint we sold because the company started, looking a little weak from the fundamental standpoint, and we did want to really start shifting. If you can see that those four companies, we have three large companies and one mid-cap company. And the companies we bought were actually only one large company and three mid-cap companies. So we do want to emphasize our mid and small cap tilt and our value tilt. So what we bought TransCanada. That's the oil and natural gas transporter. We bought Starwood. That's pretty much REIT. We bought United Rentals, which is a pretty big, the largest equipment rental company in the United States. And we bought Voya. That's an insurer with a pretty sizable presence in the investment management as well. So overall, you can see that we are sold out of two growth companies, and we bought three value companies. In our strategic dividend equity portfolio, we prefer much larger companies. They're, much more stable. In terms of style, this portfolio has a very constant value orientation because we do tend to buy companies here which pay healthy dividends. And in terms of sectors, we are overweighted in consumer discretionary, energy, telecom, and utilities. And you can see that we sold consistently. We sold Valero and New York Bank Corporation, and we bought TransCanada and Starwood. And just to kind of conclude, this is the Morningstar view of our strategical equity portfolio. And you can see that I just do want, it's a very small print here, but in terms of the large, small value growth orientation, you can see that we are pretty evenly distributed right now, but a lot of so-called blend companies per Morningstar, we do consider to be truly value companies at the moment. And that's why we believe we have a very good combination here and a slight tilt towards value. And strategic dividend equity portfolio, you can see that it's much more value-oriented and much more large cap-oriented on the same scale.
All right, thank you, Eugene. There were a few questions that were sent in. Maybe you can address, maybe we have time to address a few. One, actually, both of them were related to the sectors, and you did highlight some of the insights that we were seeing in the sectors, but specifically in the healthcare sector, Mylan Labs was in the news recently with some trouble over the pricing of their EpiPen. Do you have any views on that? And is that hurting the sector? And CVS, one of the stocks that we own, and what is your take on that?
We do have internal ratings, and they do indicate that fundamentally the biotech is actually turning around. But in terms of qualitative assessment, and we always apply qualitative assessment and judgment on top of what the numbers say. And qualitative assessment we have at the moment is that the market view of the sector is pretty negative because of the potential political risk. And this potential political risk is not going away. And that's why we kind of reduce the exposure to biotech sector by selling Gilead at the moment. And the Mylan story is just going to, reinforce the political attacks, and it might continue for a while. So we will monitor that. We will see how much of a price reduction is going to be imposed or invoked on biotech players. But we believe long term, we do believe in the sector, so we still keep the exposure to it.
Okay. How about financials? Banks haven't really done much in several years. They've underperformed. And you highlighted, the yield curve is flat and yields are so low. That's a tough environment for banks. But yet you mentioned increasing financial stake a little bit. What's your thinking on that?
Right. So as I said, in the presentation, the ability of banks to produce free cash flow is pretty amazing, and the agility of banks and the way they've restructured and made the operations leaner and much more efficient is very encouraging. And the fact that the majority of banks in the United States, especially larger ones, have free cash flow margins which are much higher than a lot of sectors in the marketplace. The only probably other sector which has higher free cash flow yield is technology. So that is very encouraging, and we believe that if there is a hint of an interest rate increase, we will see a pretty strong trigger for financials. But irrespective of this trigger, I think we're, as I said, we see so much value, so much undervaluation in the sector that it pays for us to stay in the sector and to patiently wait for that trigger. So I think the question we had was whether it's wise to kind of stay in the sector when the interest rates go sideways for a while. And the answer, yes, it is, because the undervaluation is so strong, and the free cash flow so attractive that it does pay to wait. And when the trigger happens, we will see some tremendous growth in the sector.
Great. Well, that's all we have for today. I want to thank everyone again for joining us. Hopefully it was time well spent. On the screen right now are the email addresses of Eugene and myself. You can contact either of us at any time. We also have the phone number. You can call our office. We're happy to discuss anything that we just covered in this presentation or anything more specific about your portfolio. So thank you again. Enjoy the rest of your evening, and hopefully we speak again soon. Thank you.
Thank you, everybody.